Hello MVP traders, welcome back to our another session of a learning video. In this video, we will be learning about value breakout strategy. Alright, so we have learned about a value anomaly strategy. So this will be the second part, which is the value breakout strategy. So what value breakout strategy is, in a summary, is when buyers and sellers think that the current price is undervalued, eventually bulls or buyers will take the initiative to move price away from value channel. Good breakout. All right. So when I say buyers and sellers think that the current price is undervalued, is basically when they think when the price is actually oscillating in the current value channel, is what we have learned before. Eventually, they will reach a point where the buyers or sellers think that the current value channel, the current price, doesn't really justify the stock anymore. Either it could break out to the higher level or move higher from current value channel, or move lower than current value channel if they think the current value channel is a high cost to the current stock. Okay, so the breakout that we would like to trade is when it breaks higher from the current value channel, when the buyers think that the value of this stock is much higher than where it is oscillating right now. So the buyers will go ahead and bring the price much higher. They will carry on buying. We want to take advantage of this move. Okay, so value breakout, before we go into the details of it, it's important for us to know what is reactive and initiative trading. As sellers and buyers are happy to keep the price within the value channel, as I have mentioned before. So they sell when the price reaches the sell limit, and they buy when the price reaches the buy limit, which is what we have already learned before. So this is the normal move of how the stock moves. So this is what we call as reactive trading. That means it's just the normal, usual movements that reach a buy limit, it moves higher. When it reaches sell limit, it goes lower. So eventually, on contrary, when buyer or seller decides that the current price is not the right value for the financial instrument, so they take the effort, either the buyer or seller, they take the effort and push the stock price away from the value channel. This is termed as initiative trading. That means either party, or buyer or seller, is actually taking initiative, taking the extra effort to move the price away from the value channel. If the buyer decides to take that extra effort, then the price will move higher. On the other side, when the seller decides to take the extra effort or the extra initiative, then the stock price will move lower than the current value channel. So initiative trading is usually associated with swift action and good trading volume. That means reactive trading, which is what I mentioned in the first point, is usually takes place like a normal movement, that upon reaching a buy limit, the buyers comes back and they gradually move the price higher towards the sell limit. Whereas initiative trading is usually associated with a fast move and good trading volume. That means when the initiative trading is initiated, when it's going to begin, there will be a lot of good trading volume and the movement will be fast. So this is what leads to a successful breakout, which can be highly profitable with the right money management and cut loss system. Again and again, I have to repeat this: in any trading system, any trading strategy, money management and cut loss is the key to long-term success in this trading world. And of course, the main difference between initiative trading and reactive trading, as I have mentioned before, is the speed of the price movement. So the shorter the time it takes to move the price away from value channel, the stronger the initiative is. Why is that so? Because the shorter the time is, the higher the buying momentum among the buyers if the breakout is towards the higher price. If it's to the lower side, it shows that the sellers are unable to wait anymore to sell at every price level they just want to sell. So that again shows when the speed of the price movement is fast, is swift, then the momentum is also very strong. The sentiment of buying or selling is very strong. Okay, so now we have seen the reactive and initiative trading in terms of theory. Let me just show you a simple chart to explain what do I mean by reactive and initiative trading. Just take a look at this. This is actually McDonald's stock. So if you could see over here, the McDonald's price was moving throughout this region, which is I have highlighted in the rectangle, that shows that each time it reaches the buy limit, it takes a reactive action to move the price higher. And then when it reaches the sell limit, it basically takes another reaction move. The sellers come in and they gradually move the price downwards. But as soon as the buyer in this case realized that this current channel doesn't really justify McDonald's stock anymore, basically they feel that the stock price should be valued at a much higher price, so they take initiative, they take the extra effort to move the price much higher. That's exactly what we are seeing over here. Look at it. It comes and moves in a very fast manner. The amount of volume that you see over here, which I will reveal all later on, and you can see how the price moves very fast towards the next price level. So from here, from 100 to within 120 or almost 130, it moved very fast. So this is what we explain by initiative trading, away from the value channel in a very fast, swift action, reaching the next higher price level. So this is what initiative. Another example will be the same. This initiative trading brought it to another value channel. Eventually it was oscillating over there. Buyers again realized this current price level is still much lower than what it should actually be. So they take the next extra effort, the real initiative, to continue to move the price much higher in a very fast manner. So this is how we differentiate between initiative and reactive. So this is reactive, and then the buyer or seller, they take the initiative over here, which leads to a breakout, here, and thus we see a breakout in value channel. So we want to be able to trade at this junction over here, so that we can take a profit from here, we can take the profit from here. This is the purpose of this value channel breakout topic. How can we take advantage of this value channel breakout or this initiative trading to take a good amount of profit from these stocks? Okay, so I believe that you all are clear right now what we are targeting, what we are after in this particular topic. So let's just move on and look at the first tool that we need in order to trade this particular value channel breakout. So I'm not going to go very much in detail about this moving average. It's already well written in many books, in online and such. Remember, this moving average is just an add-on tool. It's not the most important tool for us to trade this value channel breakout. This is just an add-on, which I'll explain later on how we are going to use it. So just as a quick recap, moving average is the most basic and most commonly used indicator in technical analysis, and formed by computing the average price of a stock or of whatsoever, any equities or any financial instrument over a specific number of periods. Example, 20 days, 100 days, or if in terms of weeks, it could be 20 weeks, 50 weeks and such. And so it's calculated using the close price. So basically what they do is they just add up all the previous 20 days of close price. For an example, 1 plus 1.20 and then plus 1.30, the last 20 days of closing price, then they just divide it by 20. So this is what gives them what is the moving average for that day. So each day they calculate the past 20 days. So what is the use of this moving average? So before we go into the use of it, let me just explain a small bit part of the two types of moving average. One is what we call as simple moving average. Second, we call as exponential moving average. So a simple moving average is what I have just explained before. Simple maths, the previous 20 days of stock price, the closing price, they just add up and divide by 20. Simple as that, a normal average maths. But the second part, exponential moving average, differs slightly by the overall method is still the same, but they give more importance to the recent day movements. Okay, so the recent price movement, probably the day when we calculate from now on, okay, day 19, 18, 17, 16 until yesterday, yesterday's price will have more effect on the moving average result compared to 20 days ago price. So this is what they call as exponential moving average. Okay, in moving average, basically it's a lagging indicator for obvious reason, because we are using the previous closing price, last 20 days, past 100 days, past 50 days, past 20 weeks. So it's using the past price. So it is a lagging indicator. It's very important to remember that. And it's only useful to spot entry exit point when the market is moving in a trend, either uptrend or the downtrend. Once we have a clear trend, only then it is useful to be used in trading. Apart from that, we should avoid from using moving average. It is also used to identify trend in the market. For an example, usually people say, or traders, they give a basic overview of any instrument by saying, if the stock price is above the 20 exponential weekly moving average, it's considered as an uptrend, and vice versa. Okay, or moving average is best used in combination of candlestick patterns or horizontal support and resistance. Remember this, any technical indicators, even if you are going to look at any other technical indicators, remember they cannot be used to be traded solely based on them. You have to attach it with any other technical method, like example candlestick pattern, horizontal support and resistance. That's exactly what I'm trying to say here. Okay, so it's a lagging indicator. It's useful to spot exit and entry points when the market is moving in a trend. That is the summary. So we're going to use this later on into trading the value channel breakout. So now is the time for us to go into the detail of this whole static value channel breakout. So let's take a look at this. As I've mentioned earlier, initiative action leads to static value channel breakout. This takes place when price breaks above its long-term resistance after a prolonged sideways movement. Remember, the two important thing about here is break above its long-term resistance after a prolonged sideways movement. And this breakout is usually followed by a significant price movement in the direction of breakout. So remember, when there is a price breakout, that means there is a strong momentum among the buyers. They really feel that the current price is far from what it should be. So they are very fast to take action, and they continue to buy even as it goes higher, because they feel the price should be much higher. So current price is still considered cheap among the buyers. So thus it is followed by a significant price movement. The most important rule in trading a value channel breakout, okay, is the presence of significantly higher than average volume at breakout. This is a must. Never skip this filtering criteria. So when you want to trade a value channel breakout, volume is very important. Why? Because for a price to move much higher in a very rapid manner, that means the majority of the buyers should feel that the current value channel price is far from what it should be. So when they feel the current stock should be priced at much higher, they come in a mass volume and they buy. If they don't come in a mass volume, it is easy for the sellers to push back the price lower. That is why when there is a mass momentum among the buyer, it should be reflected based on this average volume at breakout. So high volume is important, as this indicates that the insiders are part of this initiative action to bring the price higher, an indication the accumulation phase is over. More often, although it's not always, a value channel breakout is basically after a prolonged sideways movement. That is what we call a static value channel. So static value channel often is the accumulation phase in any stock. So they bring down the price, then it starts oscillating sideways. This is when the accumulation by the insiders are taking place. Once the insiders are done accumulating at this phase, at this static value channel, then finally they decide to move the price higher. Then more buyers come in when the price moves higher, thus it's reflected in the average volume. And when more people start buying, that is when you see a fast, rapid move towards the higher price level until it reaches the next price where the buyer think, okay, right now it is priced at the right level. So now it will start moving sideways again. Okay, so this is why it's important for us to be able to use the average volume at breakout. It's very important. Upon breakout, there's a good possibility for the financial instrument to continue moving higher rapidly. This is usually the phase where a lot of good news are played by the media to attract retail investors. This is extremely important. Okay, so as I've mentioned before, there's always three-phase accumulation, then it's where it starts moving higher, then finally it's distribution. So we want to be able to go into a stock at the beginning phase of where they start bringing the price higher. This is what we call as the value channel breakout. The longer, okay, this is very, very important. Take note or remember this point very clearly. The longer a financial instrument moves sideways before a successful breakout, the bigger the price move will be upon a breakout. Why? Because of this. When a stock goes through a long-term sideways movement, it shows that the insiders are buying a lot. That means they are buying continuously for a very long period. So when they are buying for a very long period, basically they need the price to move much higher in order for them to start clearing their warehouse eventually. So that is why when a financial instrument moves sideways for a very long term, the breakout will be really huge and the price may move beyond 100% return. Okay, so thus a breakout on a weekly chart is more profitable compared to breakout on a daily chart. So when you are looking at weekly chart, when you compare it to daily chart, when you see a breakout on a weekly chart, it is more convincing, it is more profitable compared to a breakout on a daily chart. So remember this very well. So now we have known that static value channel breakout is an initiative trading. It moves fast, comes with a really good volume, higher than average volume. Then the next part that we need to take point of is there are two ways to trade value channel breakout, because basically there are two types of channel breakout. First one is what I call as aggressive, where we buy upon a higher than average volume breakout. This is the first method. What do I mean by this? Just take a look at this schematic. Price been moving up and down, up and down. So this is what we call as a sideways movement or a static value channel. So eventually, when the buyers think the price should move much higher, so they take the initiative and they move the price higher. So this is usually associated with higher than average volume. So we buy upon a high volume breakout above its resistance. Remember that, two criteria: high volume, break above its resistance. So this is when we go and buy upon the price closing higher than the long-term resistance with a high volume. This is one method, which is good, but more often there is another way that we could go on and buy this stock. This is what I call as kiss of life. It's my own term when I use this. It's because you buy when there is a retest of the broken resistance. Again, the initial breakout must be associated with higher than average volume. So volume is still the same, higher than average. So when there is a retest of the broken resistance, which now it should have turned into a support. So let me just show you the schematic quickly. The same as before, the aggressive method, price moves up and down in a value channel breakout. Eventually it breaks above, okay, with high volume here, okay. So until this part, it is still the same as the aggressive method. But what differ here is there is a case of life. More often in a value channel breakout, you could see that upon price moving higher here, there will be a retracement back to its long-term resistance, which now should have turned to be a support. So this price level is where we want to buy next. Okay, so this is the second method where certain people, they don't like to buy here because it could be a false breakout. So that is why they wait until the price moves down here. It retests this long-term resistance, which is turned to be a support. We wait for an MVP entry signal, then we buy and we ride the next upcoming rally. So first method, immediately upon a breakout. Second method, only upon a retracement back to the previous resistance and support, then we go and buy. So what are the difference between these two approaches? What are the advantages and disadvantages about these two methods? Before I show that, let me just share with you a real chart on how it takes place. Now, this is basically what aggressive and case of life. Now, let's take a look into the details on how we can go about and buy a stock based on these two methods. What are the criteria? What are the rules that we should follow in order to trade such setup? So let's just give you a overview on the aggressive method first. So we wait, again, remember, do not try to buy before it actually breaks beyond, okay? So wait for price to break above its long-term resistance after a prolonged sideways movement. So remember, volume, long-term resistance, and it must have a prolonged sideways movement. The sideways should have at least two high and two lows, because only then it could be defined as a sideways movement. Anything else, that means the price is not in a sideways. So you should have a minimum two high and two low, which I've just showed you in the previous schematic. So the second criteria is price breakout must be associated with significant volume increase compared to recent volume. So in a better way to judge this, instead of just a vague detail like this, what we could use is higher than 50 days average volume or 50 weeks volume average. So it's either day or either week. Of course, if it's a higher than the 50 weeks volume average, then the breakout has more credibility, right? Because anything with a long term shows much more credibility. So we could use 50 days volume average or 50 weeks volume average can be taken as higher than average volume. So how we go about buying is we wait for it to break above the long-term resistance, the first condition after a prolonged sideways movement, and second, we should have a significant volume increase, which is we can judge by higher than 50 days volume average or 50 weeks volume average. Once we have both these conditions fulfilled, then we go on to the next day and buy it upon fulfilling both conditions. So this is how we buy using aggressive method. Upon a breakout with a good volume above the long-term resistance, the next day we go and buy. So this is aggressive. Obviously from the name you can see that this is a much more aggressive, slightly bit more riskier method. Why do I say so? Because at times aggressive method could also cause you to be in a false breakout, which I share more details shortly. In case of life, okay, we do the same thing. Every single details remains the same. Wait for price to break out above its long-term resistance after a prolonged sideways movement, too high, too low. Then price breakout must be associated with significant volume increase. So we have a sideways movement, sideways, it breaks out. With this point of breakout must come with a higher than average volume. So higher than 50 days volume average or 50 weeks volume average can be taken. So it's still the same as the aggressive method. But we do not buy at this level anymore for case of life method. What we do is we wait for price to retrace back to its long-term resistance. We wait for this retracement. Look out for MVP entry signal at this level to establish a long position. So now, once we have retraced back to the resistance turn support, then we'll wait for MVP entry signal. Upon having it, only then we go and buy. Another very good extra tool that we can have in order to confirm this case of life, it's a good to have feature, is what we bring in the moving average. So if this retracement point confluences with the 20 exponential daily moving average or 20 exponential weekly moving average, then it is a very good indicator that the stock is going to move very much higher very soon. Okay, so let me repeat, case of life pretty much the same as the aggressive method, but we do not buy at the first breakout. We wait for it to retrace. We wait until we have an MVP entry signal at the resistance turn support, then we go and buy. A good to have feature is at this point where MVP entry signal takes place, it also touches or confluences with the 20 exponential daily moving average or 20 exponential weekly moving average. So this is pretty much the theory part of these both methods. Let me just show you in the real chart what all this actually means, because only in real chart we will really have a good understanding what all this thing means. So this is an example of an ABC stock, AmerisourceBergen Corp. So if you could see over here, we were moving in a prolonged sideways movement, down, up, down, up, down, up, a minimum of 2 low and 2 high. So we have 1, 2, 3, 1, 2, 3. Then after it came down, and then it starts moving higher. So we could see over here, this particular portion comes with a higher than average volume. So this is exactly what we want. In this case, we are talking about higher than 50 weeks moving average volume. So this is higher than 50 weeks average volume. So we have a breakout, and this is what I call aggressive method. If you realize, it continues to move higher without ever coming down and showing a case of life pattern. Over here, it continues to move higher and higher and higher. You could see this is where the initiative trading has taken place. Okay, initiative trading has taken place, and as I said, when there is a real initiative with good volume, the price will move up rapidly without any stop. So this is exactly what ABC has just shown us, where it fulfilled the first condition, breakout above long-term resistance. Okay, then the second one is of course higher than average volume, and then we have a rapid up move continuously. And for in this example, it moved away from $42 up to all the way to $62, $20 within just few months. Okay, so I hope this part explains clearly what a whole breakout is all about. It must have a prolonged sideways movement, good volume above long-term resistance. Bang, we have our breakout, and we can go and buy upon fulfilling these conditions. Then we can ride on to this huge profit. For an example, in this case, that we are talking about almost a 50% profit in just few months. Now, as we have discussed about case of life and aggressive, let me just go a bit more deeper into explaining the main difference between these two methods, because both method comes with its own pros and cons. Aggressive method has a lesser possibility of missing out a successful breakout. That is the biggest advantage of an aggressive method, because not every single value channel breakout portrays or shows a case of life pattern. At times, the buying momentum is so strong that it doesn't retrace back to its resistance turn support. It just continues going higher and higher and higher. Alright, So that is why in aggressive method, you have a lesser probability of missing out such successful breakout because price doesn't always retrace. But on the other hand, the advantage of keys of life is this. Keys of life has a much lower possibility of being caught in a fake breakout. Remember, not every single breakout turns out to be a successful rally. There are times when certain breakouts are just what we call as fake breakout. That means upon breaking out from its long-term resistance, it only lasts probably 1 or 2 days or at maximum 1 to 2 weeks before breaking down again. So that is what we call as fake breakout. So when you have a keys of life, you have a possibility of avoid yourself from getting caught in such fake breakout because of the extra confirmation that we wait before initiating a long position. So this extra confirmation is what I meant earlier by it retracing back to our resistance turn support. If there is an MVP entry signal, only then we buy. So that is the extra confirmation that allows us to avoid some of the fake breakout that could take place if we were to just purely follow the aggressive method. Almost 60% of the breakout ends up as a fake breakout, and thus keys of life method provides a much higher probability of winning. So as simple as that, both method works, which is good. If you ask, my favorite is of course keys of life because of the extra confirmation, but of course aggressive has a lesser possibility of missing out a successful breakout. I'm fine with that. Keys of life will always be my best of choice. So in order to tackle this kind of both pros and cons, that is why best money management and entry strategy for value channel breakout is to use a quarter of the capital. Let's say we have just planned to invest in, if upon a breakout we want to invest about $1,000 in this stock. So the best way to go about is to use a quarter of the capital, that means about $250, to enter based on the aggressive method. Alright, so once you have entered, then what you do is you wait and see if there is a keys of life pattern. If there is a keys of life pattern, then you can add up your position, the balance 3/4. So $250 we used to buy upon using the aggressive method. Then the balance 75% we buy upon a confirmation based on the keys of life method. But let's just assume, okay, we had an aggressive breakout, then we bought the stock using quarter of the capital that we plan to use, and then there was no any keys of life pattern at all. So what do we do? So this is where we switch to the MVP trend trading strategy to add on to existing position. So in this part, you have to switch to the trend trading, which is another part about whole MVP trading method. Also in static channel breakout, static value channel breakout, remember we have discussed about how to evaluate support and resistance to give and more insight. I hope you all still remember that how we analyzed a static value channel and decide who is winning the war, the buyer or the seller. The price is oscillating on the upper part of the value channel or at the lower part of value channel. These insights are very useful to be able to judge if a stock is ripe for a breakout and a good breakout instead of a fake breakout. So these are the insights that you can use in this static value channel breakout method in order to track the best breakout and to be able to be profitable from them. So now I'm going to show you some of the real examples. So now we have known all the theories, we have seen 1 or 2 examples. Let me share with you more examples on how we can use this whole static value channel breakout and trade much better. Let's just take Johnson & Johnson as an example. This is an extremely long-term sideways market for Johnson & Johnson. So it was moving up, down, down. You could see the oscillation over here. So eventually, based on what we have learned about evaluating static value channel, about who is winning the war, the buyer or the seller, so the same we could have seen over here as well. This is a sideways market. This is actually where we could see the footprint of the insiders. They brought the market crashing down strong before bringing it up back again. So we have up, down, and continue. So we could see initially it was oscillating well between the sell limit and buy limit. And then we had a crash down below. Then we have again the sell limit and the buy limit. But eventually towards the end over here, we saw that the market was actually oscillating only between the upper value channel, only over here, without ever retracing back to the buy limit. So here we could see that the buying strength is gaining power. That means the buyers are unwilling to wait until the price goes down before buying. So as we see, we go over here, we could see that there's a possibility of having a good breakout over here. So as we went on, we could see that the price eventually went above the resistance. So over here, we have a high volume higher than its 50 weeks volume average. This is officially a breakout because we had at least too high and a too low in a sideways market. Then after we had a strong buying strength over here. Then eventually we had a breakout over here. So this breakout came with a good volume. So using aggressive method, this is where we will be buying first. Okay. So a quarter of our money management method, a quarter of it we used to buy over here the next day or the next week. Then what we do is we wait for the case of live pattern. So over here we could see that it came down. This is our resistance, which by right now should have turned into support. We look and see if there is a resistance turn support over here. So finally we actually have our pivot pattern over here. So once we have this pivot pattern, it is ready to launch. This is where we start buying again the balance position, the balance money that we have allocated for this trade. This is where we add on to our existing position. So then after we came out with a huge rally, because from here it moved all the way up until here. So you could see that if I were to minimize it, you could see the rally went up all the way from 68 almost up to around $106. So that is the kind of returns that we can actually see with this breakout method. At times, as I said, the sideways market can go on for a very prolonged period. Like example is this case. It went on for a very long period. The longer it goes in a sideways, the faster it moves higher and the larger the movement will be. So in this case, that is how it was able to move in such a large amount because of the prolonged sideways market. Another example will be McDonald's. Over here, we could see that if we were to draw the static value channel, so this is where the static value channel will roughly be. In this case over here, this is the resistance, this is the control price. Okay, so we could see over here it went up, went down, it was oscillating in the lower channel, then started oscillating in the upper channel. It came down, but it was quick to go back into the upper channel. Thus you see a lot of empty space at the lower channel. This shows strong buying momentum among the buyers, and this kind of static value channel with this kind of buying momentum, with this kind of empty space at the lower channel, indicates there is a very strong possibility for the stock to break out. So over here, what we saw over here was eventually it break out above its long-term resistance with a high volume. You could see that it had a volume higher than its 50 weeks volume average. So upon this breakout, using the aggressive method, we will go ahead and buy the next week. So over here, if we would have bought the next week, we could have ride this rally from all the way from $105 up to around $132. So these are the kind of powerful returns that we could see with this value channel breakout. So in this case, of course, we did not have our keys of life, so we could just be with aggressive, and to add on position we use the MVP trend trading strategy. All right, so I hope that makes it clear so far about how we can actually trade this value channel breakout using volume and price only. Thank you, and thank you.